Hello, my name is Hannah Bucket with Liberty University, presenting on financial analysis for Walmart. Walmart was founded in 1962. Walmart is a retail store that offers a variety of services. The major services are grocery, pharmacy, clothing, household goods, furniture, electronics, and beauty products. In its very short life cycle, Walmart has grown tremendously to be the largest retailer in the world. Its major competitors are Target, Amazon, Costco, and Kroger. Its average customer is a middle-aged Caucasian woman making around $70,000 a year. According to Business Quant, Walmart's core source of income in 2021 was grocery, making up a huge amount of Walmart's revenue at 66%. Fuel coming in at 12%. The interesting thing is these are two things that I don't think people automatically associate with Walmart. A lot of times when people think about Walmart, they think about maybe pharmacy, health, home and apparel. But the home and apparel makes up 11% of the income for Walmart. Health and wellness coming in at 6%. And then technology, office, and entertainment at 5%. The non-operating earnings had a decline in April 2022 of 21%. If you look at their revenue growth, you can see they've had revenue increasing over the past couple of years, not gigantic increases, but steady increases. For a company that's bringing in $572 million a year, this right here looks very impressive, especially looking at their consistent profit. And then you can see their net income coming in at $13 million. Earnings are considered high quality when they are sustainable. Walmart experiences high quality of earnings, and it comes from how sustainable and repetitive their earnings are. During the pandemic, while a lot of organizations were experiencing decline, Walmart was growing. As of May 21, Walmart reached its 2021 earnings forecast, well exceeding at a much rapid rate what anybody could have ever forecasted for Walmart. A big reason why they did so well during the pandemic was people were looking for low prices. They were looking for places to shop that would be affordable. And Walmart recently launched their free shipping, and that's also a huge sell to buyers. In 2021, their shares were up by 3%. And they have many, many repeat customers, which again speaks to the quality of their earnings. Throughout the years, they've continued to grow. They've continued to have a loyal customer base. And these are all reasons why I'm confident that Walmart has very high quality earnings. Walmart's operating activities. So Walmart's operating activities, you can see that peak in 2021. This is the cash flow that they receive from their regular business operations. This is the typical things that you think of when you think of how Walmart's making its money. So their sales, their inventory, the regular things they're doing on the daily at Walmart. But then they also receive money through investing activities. And you can see, if you look at the chart from 2022 to 2021, there was a slight dip in 2021, but then back up again in 2022. Investing activities, these are things that they receive from property equipment payments, payments for business acquisitions, and other types of investments. And then you have their financing activities. These are dividends that they've paid, stock that they've purchased. And if you look at the chart, you can see from 2020 to 2022, again, there was a decrease on the financing activities side. Ratio analysis for Walmart. When we're comparing the ratio analysis, not only do we want to compare Walmart for the past 3 years, but we want to look at industry averages as well as major competitors, which in this situation, I selected Target and Amazon. Typically, an organization wants a current ratio between 1.5 and 2. However, the industry average is 1.27. You can see Walmart is in 2020 was coming in at 0.79, but then has increased it over the past couple of years, ending up at a 0.93. Its competitors, Target and Amazon, are slightly higher. However, neither one of them are ending up at that 1.5 to 2. So that's an area that Walmart could improve in. Its debt to assets and its debt to equity are very good. Those low numbers always look really good, especially when you look at the competitors and you can see how Walmart is performing very well. This is showing that Walmart has low debt and is able to not have all of its cash siphoned because it's constantly having to pay out all its debt that it's owed, but instead can keep that good cash flow going because they don't have a high amount of debt. Gross profit margins consistent at that 0.25 over the past 3 years, way better than the industry average. Typically, companies want to see much higher profit margins than this. However, retail historically does not perform very well when it comes to profit margins. You can see that Target actually does a little bit better in this area, but Walmart does beat out Amazon on profit margin. Inventory turnover, Walmart does very well consistently on inventory turnover. This gives them a chance to quickly get stuff off their shelves, get new stuff on their shelves, and not have to slash prices in order to get things out of the store. Return on assets. The return on assets is really good at 0.33, 0.23, and then again at 0.23. Doing better than the industry average, however, getting beat out by both Target and Amazon. That's an area that they could improve in. A reason why the return on total assets could be decreasing over the past couple of years is probably due to inflation. So that would cause the return on assets to go down. And then the earnings per share, their earnings per share is doing well against industry average, but not well compared to the competitors. You can see Target and Amazon have a much better situation than they do when it comes to earnings per share. So recently, Walmart has struggled. They have had a huge decrease over the past 3 months in their stock valuation. So their stock dipped by 10%. You can see it was doing really, really well. And then all of a sudden in May, it just dipped very low. Shares are dropping, net sales are dropping, and this causes executives to panic and be very freaked out. A big reason why is costs are going up due to inflation, gas prices, e-commerce prices, salaries are increasing, and this is putting a pressure on Walmart because they either have to pass that cost onto their customer, or they receive reduced profit margins, which again, shareholders kind of freak out, and you can see net sales are dropping, which causes less and less people to purchase the shares, which causes the share values to decrease. And so this is a huge concern for investors, huge concern for shareholders, huge concern for Walmart's CEO. This will definitely be something they'll have to address. Walmart's strengths. Walmart has a strong brand identity. They're the largest retailer in the world. Their debt is extremely low. They offer a variety of products, and their processes are efficient. Walmart's weaknesses. They have low profit margins, and their profit margins are currently decreasing. They're competing with quickly growing companies like Amazon. And Amazon, is well known for its delivery. That's who people go to kind of automatically. And Walmart's competing right now with, trying to get free delivery, trying to get customers to think of them as a place they can go to, but they're competing because Amazon has such a good brand presence when it comes to, 2-day shipping. And so Walmart needs to come in and be able to compete there because right now they're weak in that area. Their shares are dropping, and that's going to affect their bottom line. When inflation is rising and minimum wage is increasing, it puts them in a difficult position. Walmart's always cared about offering low prices, and that's what the customer goes to Walmart for. But when Walmart starts to have to potentially increase their prices, they could lose customers. And increased costs are affecting Walmart's bottom line. Some future opportunities for Walmart would be to expand their online presence and focus on online customers, as well as considering closing brick and mortar stores. It can be difficult for a company to make that decision, especially when they've done so well for so many years with their brick and mortar stores. However, as costs continue to rise and fuel continues to increase and salaries continue to go up, Walmart has to come with some solutions to keep their prices low. And a good way to lower their prices would be to save money by eliminating some of their brick and mortar stores and focusing on their online sales. And that could be a good opportunity for them to grow in an area that they otherwise hadn't had a huge presence in before. From a biblical perspective, it gets a little complicated. Walmart does have a history of mistreating workers and is known for paying their workers low wages. One lawyer talked recently about Walmart pressuring employees to forfeit their rights to treatment when they had been injured on the job during the claims process for their workman's comp claim. This is a huge problem. Having managers at Walmart and HR at Walmart making employees feel guilty for utilizing the benefits that are given to them, especially when the employee is in a situation where they need healthcare the most. This is a corrupt thing to do. And from a biblical perspective, it's a huge problem. Deuteronomy 24:14 says, "You shall not oppress a hired servant who is poor and needy." As a Christian working at Walmart, this would be a huge conflict of interest, and executives who are Christians should make strides in trying to improve this culture. Here's my references page. And here's my final references page. Thank you so much. Have a good evening.